Selling property abroad often feels like a straightforward decision. Perhaps you are closing a chapter in another country or cashing out on an investment you have held for years. But for U.S. taxpayers, that sale does not stay overseas. The IRS expects a full report, even if the property was located thousands of miles away, and even if foreign taxes were already paid. In today's video, we shall explain how capital gains tax applies to foreign property and what has been declared to the IRS. Which exclusions reduce your tax exposure? How do you not end up paying tax twice? We walk through the rules exactly as we at GavTax Advisory Services Capital explain them to our clients. Clear, practical, with enough context for actual understanding of the decisions ahead. Understanding the IRS position. To begin with, notice why the IRS cares about a property sale that happened in another country. The United States taxes its citizens and residents on worldwide income. That means a condo in Spain, an apartment in the Philippines, a rental home in Belize, regardless of location, must be reported when sold. In so many ways, the rules shall also mirror those applicable to domestic real estate taxation. You determine your gain. You find out what your adjusted basis is. You convert everything into US dollars at the appropriate historical exchange rates, and then apply the normal capital gains rules. The geography is different, but the tax mechanics are very familiar. This is where most people innocently make mistakes that result in IRS notices later on. My gain is not simply the difference between my selling price and whatever I think I paid for it. The IRS wants a detailed reconstruction of my basis. Start with the original purchase price in US dollars at the exchange rate on that date. Add qualifying improvements, renovations, and purchasing costs, also converted using historical currency rates. If this property were a rental, depreciation becomes very important. The IRS makes you subtract the depreciation you claimed and, even more significantly, it makes you subtract depreciation you were allowed to claim, even if you failed to do so. You convert the sale price to US dollars using the exchange rate on the date of sale after establishing your adjusted basis. With everything in its right place, you can figure out the actual gain. Now, let us talk about holding periods. Same as US property. The character of your gain depends on how long you held the asset. If it was 1 year or less, then short-term taxed at ordinary income tax rates. More than 1 year, long-term qualified for those generally more favorable long-term capital gains rates. If the property were a rental, depreciation recapture also applies. This is an area where many taxpayers are caught off guard, especially when selling foreign rental property that has been owned for several years. Most people typically underestimate the filing obligations in a foreign property sale. The gain from such a sale usually finds its way to Form 8949 and Schedule D, where the details of the transaction are fully reported. If foreign taxes were paid, Form 1116 is generally used to claim the foreign tax credit. If for any reason the sales proceeds happen to pass through a foreign account, you could also have FBAR or FATCA reporting requirements through FinCEN Form 114 or IRS Form 8938. Even if, after all credits and exclusions, you finally owe zero US tax, reporting is still mandatory. There are several completely legal ways in which a person can minimize or eliminate paying U.S. tax on the sale of foreign property. The most substantial among them is the Section 121 home sale exclusion. In case your house was your main residence and you have lived there for at least 2 out of the last 5 years, then up to $250,000 if single or $500,000 on a joint return can be excluded. This exclusion applies even when the home is located abroad, as long as all requirements are met. There is also a foreign tax credit that will not allow you to be taxed twice on the same gain. In case the country where the property was located imposes its own capital gains tax, quite often you may credit that amount against your U.S. tax liability. In most cases, in higher tax jurisdictions, this credit fully eliminates any additional U.S. tax. Ultimately, capital losses from other investments can offset your foreign property gain. This involves some timing and planning, but it works as a practical strategy for most taxpayers. There are several nuanced scenarios with foreign property sales. For example, in most cases of inherited foreign property, the basis is stepped up, which massively reduces the taxable gain. Rental properties more often involve complicated depreciation calculations, and the IRS expects accurate documentation. Another important aspect is that 1031s are, for the most part, restricted within borders. U.S. property for U.S. property. Details like these are the reason it helps so much to get started planning, even just a little bit earlier than usual. Let's discuss the mistakes that consistently get people in trouble with the IRS. The sale is not reported because tax was paid in a foreign country. Completely missing from gross income because it was already taxed somewhere else. They fail to report capital gains on their U.S. return. They use one exchange rate for all numbers, which highly distorts the gain, or forget about depreciation, failing to remember foreign account reporting requirements. These are totally preventable problems when approached correctly, but become issues of complaint after the fact. How GavTax Advisory Services supports its clients. GavTax clients get the summary since they walk into our office before selling their foreign property. Compute an accurate basis, model the tax impact ahead of time, review foreign tax rules, and optimize exclusions and credits. Documentation perfectly aligned with IRS expectations, as well as cross-border compliance requirements, is also prepared. This means that a taxpayer will know his or her actual after-tax outcome before he/she commits to selling. If you have recently sold or are planning to sell foreign property, start collecting documents now. Original purchase documents, improvements, and rental history, if applicable. Consider whether you may qualify for the home sale exclusion. Prepare yourself on foreign taxation rules before negotiating a net of tax deal. And, obviously, check with a tax advisor who deals with international tax and real estate taxation. Cross-border transactions are not something to leave to guesswork. At GavTax Advisory Services, we provide our clients with the confidence and strategy in navigating these rules. If you want clarity on how your foreign property sale will affect your 2025 tax filing, visit gavtax.com to schedule a consultation. Thank you for watching, and I will see you in the next video.